While the headlines are dominated by AI launches and tech valuations, the most important market in the world, the bond market, is sending a very different signal. In December 2025, we are seeing a synchronized rise in global government bond yields. In the US, the 10-year Treasury yield has climbed above 4.14%, rising 40 bps in just 1 month. We see similar moves in Australia, where yields rose to 4.51%, and across Europe. This is happening despite the Federal Reserve cutting short term rates. This phenomena is called bear steepening, and for investors, it matters more than the daily stock market noise. Today, we are going to look at the data to understand why yields are rising, what the term premium tells us about 2026, and how this impacts everything from startup valuations to real estate. So let's dive in. First, let's look at the facts. The Federal Reserve cut rates in December, which usually pushes yields down. But the opposite happened. Long term yields rose. Why? The market is pricing in two specific risks. First one, sticky inflation and growth. Economic data in late 2025 has been stronger than expected. The US labor market remains firm and inflation is proving sticky, meaning it isn't falling as fast as the central banks hoped. Bond investors are demanding a higher return, that is yield, to lock up their money for 10 years because they fear inflation might erode that value in the future. The second point is the term premium is rising. This is a key concept. The term premium is the extra compensation investors demand for the risk of holding long term debt. With US government deficits remaining high and fiscal policy likely to stay loose globally, investors are worried about the supply of bonds. If the government issues more debt, the buyers demand a higher yield to buy it. That risk premium is expanding. This isn't just a US story. If we look at Europe, German and UK yields rose 30 basis points in December. In Australia, 10-year yields hit 4.51%, driven by higher local inflation data. In emerging markets, Brazil saw yields jump over 100 basis points in a single month as the central bank hiked rates aggressively. This synchronization tells us that capital costs are rising globally. The era of easy money isn't returning as quickly as the equity market hopes. The bond market is effectively voting that rates will need to stay higher for longer to keep inflation in check. So, why does this matter for you? First, let's understand how it affects the tech and startup valuations. Growth stocks and startups are long duration assets. Their profits are expected far in the future. When the risk free rate, that is the 10-year treasury, rises, the discount rate used to value those future cash flows also rises. Mathematically, a higher discount rate lowers the present value of a startup. If yields stay in the 4 to 5% range through 2026, we could see valuation multiples compress regardless of the AI hype. The second reason is corporate debt. For companies carrying debt, refinancing is getting expensive. Investment grade spreads tightened in December, but high yield, that is junk bond, spreads are widening slightly. This signals that the market sees more risk for lower quality companies in 2026. The third reason is the cash advantage. With yields rising, short term bonds and cash equivalents remain competitive. You can get 4% yield with very low risk. For conservative investors, fixed income is finally offering real income again. Looking at 2026, there are two reasonable scenarios. Scenario A, the soft landing holds. That is, inflation slowly drifts down, allowing yields to stabilize in the 4% range. This is the Goldilocks outcome where stocks can perform well, supported by earnings growth. Scenario B is the bond vigilante shock. If governments continue massive deficit spending, bond buyers could go on strike, pushing yields towards 5%. This would tighten financial conditions rapidly and could cause a correction in risk assets, namely stocks, crypto, real estate, etc. The bottom line, don't ignore the bond market. Right now, it is telling us that the fight against inflation isn't over, and the cost of capital is going to stay higher than we got used to in the last decade. As an investor, focusing on companies with strong cash flows, companies that don't need to borrow money, is the safest play in this environment. Let me know what you think how this will play out in 2026. Share your thoughts in the comments below. If you found this analysis helpful, subscribe for more deep dives into the data that actually moves market. We'll be back next week with another story from the front lines of global investing. We see 10x.